You can be wrong many times in life and still become extraordinarily successful. Think about that for a second. It completely defies how most of us are wired, right? From the time we're in school, we're basically taught that perfection is the baseline. We think that to get an A in life, or in business, or in the stock market, we literally need to bat 1,000. But what if the exact opposite is true? What if the real secret to building incredible, generational wealth actually has nothing to do with being perfect? But let's dive right into this because this concept is an absolute game changer. To win big, you honestly don't need to be right all the time. You just need to survive. It sounds incredibly simple, but man, it's so difficult to actually execute in practice. In this explainer, we're going to completely dismantle that deeply ingrained assumption that financial success requires some flawless track record. As you'll see, survival and endurance, not sheer intellect or a perfect batting average, are the true, undeniable metrics of massive wealth creation. Welcome to Tails You Win, the math of extreme wealth. Today, we're decoding the hidden math of the ultra-wealthy. Think about the biggest names in American business culture. You know, the massive tech titans out in Silicon Valley, the legendary investors on Wall Street. Behind the exploding stock charts and those cinematic success stories is a hidden mathematical reality. We're going to uncover how probability, asymmetry, and just ruthless consistency are the real drivers of extreme success. Section 1. The myth of perfection. You know, in investing and entrepreneurship, the psychological burden of needing to be right all the time can actually be your absolute biggest liability. It paralyzes your decision-making and forces you to overreact when things inevitably go sideways. So this explainer is grounded in the brilliant insights from Morgan Housel's modern classic, The Psychology of Money. Housel makes this fascinating point. We all do crazy things with our money because we're making decisions based on our own unique lived experiences. But while our emotions are super individualized, the underlying math of extreme success, it's remarkably universal. And that universal truth starts with totally shattering our expectations. See, conventional wisdom tells us that success is just this linear path of always picking winners and executing a completely flawless strategy. But the actual financial reality, it is messy. It's defined by massive failure rates, punctuated by really rare extreme outliers that make up for all those losses. When we look at highly successful people, we're basically just watching their highlight reel. We don't see the graveyard of failed ideas, bad investments, and strategic blunders that actually pave the way to their ultimate success. Section 2. Tails drive everything. Okay, this brings us to a concept that is going to fundamentally shift how you evaluate risk and reward: the tail event. Basically, this is an outlying, 1 in thousands or even 1 in millions event that drives the vast majority of outcomes. In finance and business, literally anything that is huge, highly profitable, famous, or globally influential is almost always the result of a tail event. The issue is, because these huge successes are all we ever really pay attention to, we vastly underestimate just how rare they actually are and exactly how much failure surrounds them. To put that into perspective, look at the elite Silicon Valley ecosystem. When Correlation Ventures analyzed over 21,000 venture capital financings over a 10-year period, the results were just staggering. The vast majority of these investments are essentially failures, startups that completely flatlined or lost money. Then you have a tiny sliver that provided some modest returns. And that barely visible sliver at the very top, those are the absolute bonanzas, the rare tail events that drove essentially 100% of the entire industry's returns. The smartest investors in the world literally expect to be wrong most of the time. They are deliberately hunting for the tail. Section 3. The secret of survival. So if failure is really that common, how do you actually stick around long enough to catch one of these massive tail events? Well, getting wealthy is one thing, but staying wealthy is another entirely. These are two completely different skill sets. Getting wealthy requires risk-taking, tons of optimism, and really putting yourself out there. But staying wealthy, it requires the exact opposite. It takes humility, a healthy dose of fear, and a desperate desire to protect what you already have. Survival absolutely has to be the cornerstone of your strategy, because compounding only works if you can give an asset years and years to just grow. I want you to burn this number into your mind: 400. That is the number of cartoons Walt Disney actually produced by the mid-1930s. His first studio went completely bankrupt, his films were monstrously expensive to make, and most of those 400 cartoons lost an absolute fortune. I mean, can you imagine the emotional persistence required to fail 400 times? But Disney survived just long enough to hit his tail event, animations like Snow White and Steamboat Willie that fundamentally changed American entertainment and created a billion-dollar empire. He wasn't right every time. He just survived the 400 wrongs. Or consider the number 10. Warren Buffett is arguably the greatest investor of our time. We always picture him sitting on Wall Street, just effortlessly picking massive winners. But at a Berkshire Hathaway meeting back in 2013, Buffett openly stated he's owned 400 to 500 stocks during his life, and he made the vast majority of his unbelievable, world-changing wealth on just 10 of them. Out of 500 swings at the bat, it was 10 massive home runs that totally defined his career. His legendary business partner, the late Charlie Munger, hit the nail on the head with this. He said, if you remove just a few of Berkshire's top investments, its long-term track record is pretty average. That is absolutely wild to think about. It brilliantly illustrates that even the absolute masters of capital allocation rely heavily on a tiny fraction of extreme outliers. They look like complete geniuses, not because every single move they make is flawless, but because they structure their portfolios to survive the misses and absolutely maximize the hits.
Section 4. The math of asymmetry.
So, why exactly does a handful of wins matter so much more than hundreds of losses? Billionaire investor George Soros captures this perfectly. He says it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. And guys, this is the absolute essence of asymmetrical upside. Think about it. If you invest in a stock, the absolute most you can lose is 100% of your investment. You hit zero. But the upside? A stock like Amazon, Apple, Tesla, or Microsoft can return 1,000, 5,000, or even 10,000% over a couple of decades. One single massive winner can mathematically erase the sting of dozens of complete wipeouts. But here's the catch. To capture that asymmetric upside, you absolutely must avoid ruin at all costs. As the famous author Nassim Taleb points out, having an edge in the market means absolutely nothing if you get wiped out during a bad year. If you leverage yourself to the hilt or, invest cash you actually need for next month's rent into some risky startup, a temporary market dip suddenly becomes a permanent loss of capital. You're forced out of the game completely. You cannot use your edge if you do not survive the lean years.
Section 5. Staying in the game.
Okay, so how do we actually apply this practically? Here are the core tenets of the survival mindset. First, you've got to become psychologically okay with a lot of things going wrong. It's mathematically normal. Second, judge your full portfolio or your entire body of work over a decade, not just your individual failures. A string of losses doesn't make you a failure. It just makes you a participant in reality. And third, you must worship room for error. A margin of safety, whether that's an emergency fund, a widely diversified portfolio, or just a really conservative business plan, that is the armor that protects you from the unexpected. Because at the end of the day, room for error gives you endurance. It prevents you from being forced to sell at the absolute bottom. And endurance? Endurance is the only thing that gives compound interest the time it actually needs to work its absolute magic. Compounding really isn't intuitive. It's this slow burn that suddenly explodes into massive wealth, much like the tail events we've been talking about. But it demands time, and time demands survival. So the ultimate takeaway here is this. The people who win big are not always the smartest. They're often just the ones who stay in the game long enough for the odds to work in their favor. You don't have to be a prophet. You definitely don't have to be perfect. You just have to build a life, a portfolio, and a mindset resilient enough to survive the failures so you're actually standing there with your net out when the lightning finally strikes. So I'll leave you with this question to think about. Are you building your financial life for perfection, which is basically impossible, or are you building it for survival, which is where the real fortunes are made?